Okay, back to our strategy. Those are what the things to avoid. Let's say we were negative. Now let's be positive and say, here's what you can do to survive and prosper in the coming financial crisis, or in the continuing financial crisis. First of all, own precious metals up to at least a third of your portfolio. Now, I've got to be honest, I own a lot more than one-third in my portfolio, and it's not just because I'm in the metals business. It's because I believe so very, very strongly about the things we're talking about here tonight. But we would say that most people should have at least one-third of their portfolio in precious metals, physical gold and silver coins in your possession, two-thirds U.S. and European semi-numismatic gold coins, one-third in junk silver bags and silver dollars. Okay, silver's got good upside potential, but if we should roll over into a deflationary depression after an initial drop in gold, gold would go back up and silver might keep going down. Gold was up and silver was down in the Great Depression. We like gold better than silver, but we basically recommend a two-thirds, one-third split. Okay? Now, I think it's just interesting. Just since last July, we've seen a 53% gain in gold. We've seen, on the bottom left, we've seen silver price only go up 80%, platinum price up 85%, palladium price up 82%. How can Wall Street ignore that? How can they ignore that? That blows my mind. Okay, so we're talking a strategy, and we're saying that you should own at least 35% of your portfolio in precious metals. I would also own some precious metals shares, perhaps 15% of a portfolio. David is kind of the expert in our firm on the shares. He came out of Morgan Stanley and did a lot of work with gold shares when he was there. There are some gold shares that you want to have, but you don't want to be in South African gold shares. No, no, no. That is a definite no-no. Tremendous political problems and economic problems. They can't even run their electric power grid down there, and their mines are closing down because there's no electricity. But they've got big, big political problems coming. They've just elected a new leader that's going to be the next Robert Mugabe or Idi Amin. And so you don't want to be in South African gold shares. I would, as we said with the other stock certificates, I would take delivery of your stock certificates if possible. And you want to be careful of being in gold stocks that are in countries that might seize the gold stocks. Like Hecla Mines has huge mines in Venezuela. Well, Mr. Chavez is not a nice man. He's a communist who might just want to take it. Newmont had problems with some of their mines in Indonesia. So basically, you need to remember that paper gold is not gold. It's not the same as having physical gold in your possessions. And in a major financial crisis, your paper gold, your gold stocks could do poorly. They haven't done that well in the last year or two, but before that they did quite well, and I think you'll have some nice rises in the gold stocks. But the day is going to come in the next few years where I will get out of my own gold stocks and roll that into the metals themselves. I think it's wise to own natural resources and energy stocks, perhaps 15 to 20% of your portfolio. We like food and other soft commodities. Wheat, corn, soybeans, sugar, cocoa, rice, coffee are all set to make substantial gains in 2008. Although understand that there are food companies and energy companies that, because of incredibly fast rising prices, even when you're in this commodities bull market, they can still lose money. So you got to take some care there. I would move, this one's really important, I would move 25% of your liquid assets out of the United States. That's a pretty new idea for most American investors. It's not something that most Americans have ever thought about. They'll diversify in their portfolio, but diversifying geographically is not something that's really crossed most people's minds. But we would say only do that if you've got a liquid net worth of $500,000 or more. And we think the place to go is Switzerland. And the reason we think this makes sense is because you basically have all your assets tied up in the U.S. dollar pool. And if the dollar goes to 52, which is another 25-30% drop, or 42, or whatever, I think you're gonna have major problems. By the way, let me give you no extra charge for this one, but the ultimate direction the dollar is going to go is so low that they will replace it with the new currency. And the new currency will be the little baby sister of the euro, and it'll be called the Amero. And it'll be the currency of the merged United States, Canada, and Mexico, which is being called the North American Union. 22 working groups within the U.S. Commerce Department right now. Folks, they're pushing this thing so hard and fast you can't believe it, and they've already got the Ameros on the drawing boards, and I think one of the reasons they're allowing the dollar to drop so far is because at some point they will stand up and say, folks, to be competitive with Europe, we got to have a united currency. Here it is, the Amero, and it'll be a fait accompli. Okay? But I think there's other reasons, not just because of the dropping dollar, to have some funds diversified out of the country. I believe, along with other observers of the present-day scene, that you're going to see a lot of political controls come in with the next administration, whether it's a Republican or a Democrat administration. I think exchange controls will probably be part of that. I have friends in Europe who are very, very well dialed into what's happening in America and Washington, who believe within the next year or so we could have foreign exchange controls which would block people from moving money out of the United States. So we think having some money overseas, primarily in Switzerland, is a good idea in the form of physical gold coins, storable in Zurich, and we now have a mechanism whereby we can deliver our clients gold coins to a depository near the Zurich airport in Zurich, and we think we're going to have more and more clients interested in doing that. We'll see. But you can